What you always imagine is that the bank has all these capabilities to support you. And once you're within the fold, they'll support you and everything will magically open up and be easy to do. And the answer is yes, they can. But even when the spirit is willing, the flesh is very weak. Banks' ability to acquire tech startups is much more limited than people realize. For any bank outside the top 10, 100 million acquisition is already very tough. The single biggest thing you need to have as an entrepreneur is just persistence.
Hello, everyone, and welcome to Fintech Leaders, coming to you from New York City. I'm your host, Miguel Armaza. I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage fintech entrepreneurs in the US, Canada, and Latin America. If you enjoyed this conversation, I invite you to leave a review on Apple Podcasts, Spotify, or wherever you get your shows so more people can learn about fintech leaders. Today, I sit down with Shamir Karkal, co-founder of Sila, a fintech company that's raised over $20 million to modernize payments. Shamir is also a true OG in fintech. He previously co-founded Simple, the first US neobank built for the smartphone era, and sold it to BBVA in 2014 for $117 million. This episode, we discuss selling Simple to BBVA and the post-acquisition challenges of integrating to a big bank, company building lessons and the importance of good timing, the real reason why banks do not buy fintech companies too often, why Shamir is bullish on consumer fintech making a comeback, and a lot more. Shamir, thanks for joining Fintech Leaders. Honored you are stopping by all the way from California, is that right?
Portland, Oregon, actually.
Amazing. Portland, Oregon. Why did I think you were in California?
It's just up the coast, man. It's not that far. I'm down in California often enough, honestly.
So, Shamir, I'd love to hear for the audience briefly a bit of your story, because I've heard this, but you're probably one of the, I want to say grandparents, because you're not that old, but the parents of fintech. You're one of the first neobanks to ever launch, at least in the mobile era. Sold it to BBVA. You stayed for a while, and now you're back at it you have been in for a few years with Sila, another fintech. But take us through a bit of the details of that. And then we're just going to talk just real reflections, right, from you about entrepreneurship, about integrating into a bank, and just many other things around fintech.
Happy to do that, man. So let's see where to begin. I've been in fintech long enough that when I started, it was called financial services. So I used to be a software engineer, grew up in India, came to the US 21 years ago now. Went to business school, then worked as a consultant at McKinsey for a few years. And that's where I kind of got into financial services. My first project at McKinsey was for a very large processor, a very large technology processor that's been around for decades, right? Old school banking processor. And 3.5 years at McKinsey, I did like 90% financial services. That was not the plan. I had no plans when I went into McKinsey. I was a generalist, but ended up specializing quite a bit in banking and payments, but sort of very broad. I did everything from, cross-sell strategy for bank processors to country bailouts in the Middle East. Right. And that was the 2006 to 2009 era. So it went from the boom to the bust and got to see lots of insane stuff, especially during the bust. And I spent some of that time in the US. I went and lived in Europe for a while. But then in 2009, my friend from business school, Josh Reish, he reached out to me and sent me an email saying, let's start a retail bank. And Josh was an ex-entrepreneur. He'd worked at a couple of startups as an early employee and then had gone on to work at a hedge fund. And he just got frustrated with his personal banking. And he's like, why is banking in the US so bad, even compared to banking in Australia where he was from, or banking in India where I was from. And then we started chatting, and then he was like, let's just start a bank and fix all of it, right? And I was like, well, yeah, we could do so much better now in the mobile era with like not just web first, but mobile first, right? This was '09. So mobile apps from banks were, I don't even know if there were any, but they were very early, right? So I got excited about it, moved from Europe to New York and started up Simple in Josh's basement in late 2009. It actually took us 3 years to launch because nobody had built a neobank before. And we didn't even call it a neobank. The word neobank didn't exist. We just called it a bank. And that had a lot of regulatory troubles with that. But, that was just one of the many troubles we had. And we ended up launching it 3 years later in 2012 and grew it nicely. And then 2014, it was acquired by BBVA. It's a large Spanish bank. That time, BBVA was looking to expand rapidly in the US. They had done relatively well in the financial crisis, and so were expansionist at that point. And a few months after the acquisition, I heard about this idea at BBVA of building a platform. And I got very excited about it. And I was like, yes, please do it. The world needs API platforms in banking. And if something like this had existed, then Josh and I wouldn't have spent 3 years just trying to cobble everything we need together to launch Simple, right? So I became an advisor, and long story short, a year later, I was running that business. So I built and launched 2 API platforms for BBVA, both internal ventures. One was, I think it was the first PSD2 style platform in Europe, launched in late 15, actually, long before PSD2 was even implemented. And then the other was the first BaaS platform from a bank in the US, which was the BBVA Open Platform. But I got frustrated with it and left BBVA in 2017 and then thought about what to do with life for a while and, did a little bit of advisory work here, was an EIR for a while, and then decided that I still wanted to solve this problem. I didn't want to do it at a large bank. So started up Sila in 2018. And, we're focused on helping folks who want to build fintech applications, get them off the ground, right? Most our target market has historically been early to mid-stage fintechs. And I'll say that with a bit of a caveat because it's not all startups. It's everything from small self-funded teams to like a government agency in our customer base, right? So, but it is mostly people building their first fintech application without much understanding of like banking or the world of payments. And we are a BaaS platform of sorts, but we typically don't focus on neobanks or what I think of as like core deposit accounts. We focus a lot more on payments and especially ACH payments. And yeah, been doing that. Also fairly active angel investor. It's, I don't do angel investing as a full-time job, more as like a sideline, but I've been very, very successful as an angel investor. And I realize looking back on it, that's mostly just luck and timing.
Yeah, I think you had mentioned that back there, TransferWise, Wise today is one of those angel checks, right?
Was one of my first 2 angel checks, and the first 2 angel checks returned me like 2x and 300x.
On average, 150x.
No, if you weight that average, it's way better than 150. But I mean, I made a lot more investments since then, and I have not made that sort of a return again. It's possible I never will in my life because, it's relatively rare for a seed check that you write at like a seed valuations of whatever it was. I don't even remember, 10 million or some around that much, right? To then go on and then become a public company a decade later.
Yeah. So, Shamir, tell us about the experience of integrating into a bank. And, BBVA might be a great bank. I don't know. I've never worked there, but it's still a multinational behemoth, right? With tens of thousands, maybe hundreds of thousands of employees. And here you come as a fintech. What was the hardest part of that integration?
I think the hardest part of it, looking back, and I think both BBVA and Simple did it relatively well. I mean, now looking back on it, I'm like, there was definitely a few missteps that we did, which I wish we had. I know exactly how I would do things differently, but that's hindsight is 2020, as they say, right? But overall, I think BBVA and Simple did it relatively well until the pandemic, and then the pandemic screwed everything. But the thing that I think surprised me the most. And remember, I was familiar with large banks and organizations. I'd consulted for them many times, right? But it's different when you're not just delivering a set of recommendations and being like, CEO, call me if you need anything more, right? When you actually have to make those recommendations and that plan into reality, you realize that this is true of all large organizations, that even when the spirit is willing, the flesh is weak. But it is especially true of large banks, I feel like, and large FIs in general, is that there isn't any sense of urgency. There never is. And so for you, you're like, listen, I might have 10 million in revenue, and I need to get to 50 million in revenue. And that's huge for you. And for a startup in the world, like going from like 10 million to 50 million in revenue, that's like going from Series B to like a Series, DE, right? That's where your valuation could go north of $1 billion, right? You could become those fabled unicorns, definitely in 21, maybe not today, but whatever, right? But in a large organization, it's like, we made 300 million in profits last quarter. Your 50 million in revenue without profits is like, you're far down my list of priorities. And in fact, for anybody in the large organization, it is much more profitable to slightly tune the existing business, right? Like if you can turn one of the dials on the existing business slightly up and your 300 million of profit goes up by 10% or even 5%, that's way more in profit and direct impact than whatever any internal startup can deliver in its first decade, probably, right? So you just struggle that even when you get the attention of the top folks, and BBVA was unique in how focused the top team was on innovation and change. I don't know how many people BBVA had, but at least 30, 40,000, maybe 100,000 across the globe, right? Tens of thousands in the US alone. You need not the CEO it can kind of give direction, but he's never actually implementing anything. It's like 6 levels below him, right? It's actually 3 levels below the country CEO. So when it gets down to the level of people who actually need to do things to move your project or plans forward, they're just like, well, I've got like 20 other things that I need to do. And you're just never a big enough priority for them. So it's really, really hard.
I'm guessing that also becomes a challenge because you have your own earnout targets that you want to hit.
Yeah. And, the earnout targets can be tweaked. You can do a lot of negotiation to change things after the fact. But ultimately, the ability to achieve those is not in your hands in the same way it is when you're like a VC funder, right? What you always imagine is that the bank has all these capabilities to support you. And once you're within the fold, they'll support you and everything will magically open up and be easy to do. And the answer is yes, they can. But even when the spirit is willing, the flesh is very weak. So you're like, hey, there's these 20 things that I can do. You're like, yes, but it will take you like a decade and a half to do them, because that's the pace at which the bank operates. In the real world, as an independent company, you can probably only achieve one of those things. But guess what? You can partner with 50 or 100 banks. So the chance of finding one bank that is the stars align and is actually able to move fast to what you need is much better than, so it's like what you're able to do it's almost like you cannot do the breadth of things, but you get the things that you do, you can do them much faster and much better independently than within the large organization. This is also, I from all I've heard, this is true of like being acquired by like Meta or Google as well. But there's one massive difference with FIs. Because they are so heavily regulated and compliance is so powerful, there are thousands of people in any large bank who can tell the CEO to fuck off and he will have to fuck off. Right? I mean, like if Jamie Dimon wakes up and says, I want to go do this, and some mid-level functionary in compliance says, but this is not compliant with the law, Jamie Dimon will have to say, well, I guess we're not doing it then. And maybe he can fire that compliance person, and then the next compliance person will probably do exactly the same analysis, come up with exactly the same result, right? So their ability to influence and push and prioritize exists, but they do not have the direct authority to override large chunks of the organization the way that a tech company CEO could, right?
You can't just pivot all the way to the metaverse.
No. You kind of have to be like, well, we're going to make this a compliance priority, but then you're going to have to do whatever compliance tells you, right? And compliance might be like, oh, you made it a priority. Well, in that case, instead of getting to it next year, I'll get to it in a couple of quarters. You're like, no, but I need it tomorrow. Right? There was one point I remember at BBVA where we needed to make a change to their core. And it was literally one field that had to be expanded, I think, from 6 characters to 11 characters. That cost us 6 months and $200,000. And it was amazing because it was actually doable. I think at most large banks, if you said, I want to change the core processing system, it's like, yeah, we'll pencil that in for the next decade. 2029 is maybe possible.
And Shamir, you mentioned there were some missteps along the way. Maybe share one of those. And I ask because right now we're in the point of the market where, there's a number of entrepreneurs that are being acquired. I mean, Pismo was just acquired by Visa for $1 billion. And I'm sure there's going to be a lot smaller acquisitions this year.
Yeah, I would expect so. This year and next year, I think there will be many more. But the missteps, I mean, I think one of the major mistakes that Simple made was we were in the middle of a technology transition when BBVA acquired us. And so we completed that technology transition. We transferred one of our card issuer processor from a company called TXVia to actually First Data, which is now part of Fiserv. And then we immediately finished that transition. And then we transitioned off First Data to BBVA's core processing system and their own internal API platform, which was being run by this co-founder who had moved from Simple to BBVA, right? And we made that all work. And it was a transition that all of those went better than I feared, especially the second one when Simple moved from First Data to the open platform. That was an amazingly successful transition. I still use it as kind of like a textbook of how to do these things properly. But it meant that for like 3 years, all that Simple did was just like transitioning. Right? You're like, let's freeze, let's slow down new product development and then switch from A to B. The moment we finish switching from A to B, we start the plan of switching from B to C, right? And then by the time you're done with that, you realize that your customer base has may not little more than doubled, but not quite tripled. But in that time frame, you have gone from being the undisputed industry leader with product that was head and shoulders above everybody else to being number 2 in the industry. I think maybe Chime had caught up by that point or was beginning to catch up by like 2017, 18, right? And Simple had to then relearn how to be innovative. And BBVA was never was innovative for a bank. It was not innovative at all for a startup. And Simple had become more bank-like and less startup-like. So when at the end of it, we were like, okay, we're finally on the open platform. We finally can do all the things that we want to do. And it's like, well, where's the long list of things? And let's get them out of the door quick. And that just never happened as quickly as we needed to. And I think from 2018 onwards, I think Chime pretty handily outcompeted Simple and became the number 1. And that was a big loss. Looking back on it now, I wish that we had actually, I don't know if we would have succeeded. Right? But I wish we had fought BBVA or pushed BBVA and said, hey, let's not transition. Let's just go out and capture a couple of million customers and cement our position as number 1. And then we'll transition, right? And go from A to B, triple in size, and then go from B to C. I don't know if that would have, it didn't even occur to us back then, right? But I think that was now in hindsight, the smarter play to make.
You don't see that many acquisitions of fintechs by banks. Simple is a bit of an anomaly. I mean, it's not that it doesn't happen, but it doesn't happen that much. But there are some specific reasons as to why. Maybe take us through some of those reasons.
So, when you look at JP Morgan Chase, and I don't know what their current market cap is, but it's north of 100 billion, right? And that's large for a bank. And when you look at a multi-$100 billion public company, you expect that they can acquire multi-billion.
500 billion.
Yeah. So if you took a 500 billion tech company, you would expect them to be able to do 100 billion acquisition if they really wanted to. 50 billion acquisition, no problem. 10 billion acquisition, they could do, if they're a really acquisitive company, they could do like 2 or 3 10 billion acquisitions every year, right? Chase at 500 billion cannot do an acquisition larger than 2 or 3 billion. And that's a surprising thing. When I say they cannot, I mean they literally cannot. And the reason is because of how bank accounting works. So banks are highly leveraged entities, right? So they have, when you look at bank capital on the accounting, like the financial statements, Chase may have, let's say, 20 billion, maybe 50 billion of equity. And this is heavily regulated. They need to have a certain amount of what's called tier 1 capital to hold against their balance sheet. Their balance sheet is like 3 trillion, right? So on that 3 trillion balance sheet, there's only like call it, I don't know the number, but like 50 billion of equity because they're a highly leveraged organization. They're like 90, 95% leveraged. But a standard company, 50% leverage would be very high. This is just the way banks work, right? And so bank accounting is hugely important, and the regulators impose very hard kind of like limits on what banks can do. And one of the accounting things that happen with tech companies and startups in general, if you look at a startup with a value, let's say they make 50 million in revenue and they have a valuation of $1 billion. When you look at their actual like balance sheet, you'll find that fixed assets. What are the fixed assets of a startup? It's the computers and the office chairs and desks, and that's it, right? That's not even going to be, let's call it $1 million at max, right? For 1,000 employees. Computers are just not that worth that much, right? And then you're like, everything else is software, it's IP, it's trade secrets, it's the business, but those are all intangible, right? They're not physical assets like real estate or whatever. And so, and the company itself has typically like negative equity on the balance sheet, right? Because all the money it raised, it's burned through, and it's probably not made profits for decades to add to that, shareholder equity on the balance sheet. So when the bank buys it, and let's say they buy it for $1 billion, then they have to account for that on their balance sheet. And the way they do it is through this accounting item called goodwill. So they say we spent $1 billion and we acquired an asset that's worth $1 billion. The tangible assets of that, which was worth 1 million, got added to our tangible assets, and our tangible assets went up by 1 million. But then there's this intangible asset, which is clearly worth 999 million because we spent $1 billion acquiring it. How do we account for that on the balance sheet? We put it in a line item called goodwill, right? And this is how accounting works. It's true for all acquisitions. The thing about banks is that goodwill does not count toward regulatory capital. So if you have a tier 1 capital of, let's say, 10 billion, you just took 1 billion of that and went and bought a tech startup. You now replace 1 million of tangible assets and 999 million of intangibles. That doesn't count as regulatory capital. So for regulatory capital purposes, you just burned it. And so your regulatory capital fell. But there are very strict limits on how far they can fall. Most large banks and even medium-sized banks in the US are overcapitalized right now. But you can figure it out. You can go and say, hey, the level for a well-capitalized bank in the US, I think, is around 8 to 10% right now. Call it 10%. How much is JP Morgan Chase's regulatory equity over 10%? That is literally the amount that they can actually, if it's 11%, then that 1% multiplied by their balance sheet is how much they can go and acquire, right? And that is a very massive risk for them to take. Because if they are well capitalized at 11% and then they just go down to 10, the regulator is going to ask a lot of questions about that, but they will be able to do it. If they go below 10, they probably can't. So despite being like a 500 billion bank, I think probably the largest acquisition Chase could do is sub 10 billion, and that is Chase. BofA is even smaller, Citi and Wells and everybody else is small. It's different when they're acquiring a bank. If they acquire another bank, Chase can acquire a 100 billion bank because that 100 billion bank will come with its own regulatory capital. And so if that bank is not well capitalized, it's at 9%, Chase is at 11%, the blended average of those is probably 11.5. Chase is still fine, right? But not with a tech startup where 99% of the value will go to goodwill, which is just a zero for regulatory capital. So long way of saying that banks' ability to acquire tech startups is much more limited than people realize. For any bank outside the top 10, 100 million acquisition is already very tough.
And Shamir, I know you're bullish on fintech. I am for sure. But are you also bullish on banks and mid to large size banks? Because over the last decade, most of them have only gotten bigger.
Yes. So you have to think of the timelines here, right? Global financial services is about a 20 trillion revenue industry out of a global GDP of like over 100 trillion, right? And that makes sense. The global economy is built of manufacturing and logistics and agriculture and finance. Technology is a very small component of it still overall. It's rapidly growing, but from a very small base. Out of that 20 trillion, I think the US is whatever, 6 to 7 trillion. It's still a huge chunk of global finance, but not the majority. And all this fintech startups from like PayPal to Sila, or everybody over like 25 years combined, I don't think is even at 2% yet.
You're right. It's about 2%.
Yeah. And probably more if you look at like stock market capitalization. Somebody told me they did this once, and they calculated it as like all of fintechs combined as to financial services was like 2 to 3% in stock market capitalization, but in revenue it's less because the multiples are different. And so I'm like, this will change. This decade, it was around 1% in 2020. It's already about 2% now. And I think it'll go from 1 to maybe 10% in this decade. But in 2031, 90% of global financial services will be run by the same people who ran it in 2000. Heck, almost the same people who ran it in 1990. And it's just not possible. Just the math and the numbers and the complexity, like the way that tech revolutionized like advertising and media, these were all tiny industries. Like advertising is 600 billion globally, right? Media is what? A couple of trillion globally. These are nothing. Like finance is like 10 times larger than the rest of them, probably 5 times larger than the rest of them combined. Technology is not going to revolutionize it in a decade or even in 2 decades. This has been taking my lifetime. When I was a little kid, my parents were bankers. My mom in the late 80s was there when the first computers were rolled out in her bank branch, right? That was a huge thing. So it has taken my lifetime to get this far, and I'm well into my 40s now. I think we will be seeing the time like where tech is 30-40% of financial services by the time I die. Maybe we'll get to 50. But the other thing that's changing is that these two worlds are rapidly becoming the same. Even today, you can make a distinction between a fintech startup and a traditional FI. But I think in 10 years, 15 years, 20 years, you'll be like, is PayPal really a fintech startup? I question that today, right? I mean, to anybody in the fintech world, they think of PayPal as an incumbent. They think of Visa and of definitely Visa and MasterCard as incumbents. And heck, they think of like Chime as an incumbent now, right? And so you're like, well, I could totally see Chime. Square already did it, and there's a lot of regulatory things, but I could totally see somebody like a Chime getting a regulatory license and in 15 years looking just like a more online version of Chase. So these worlds will merge. Chase and the large traditional banks are becoming more and more online as rapidly as they can, given understanding that their average customer is 55 and they still need to service that customer because they're very wealthy 55-year-olds. While the average customer of Chime is probably 32, and those will also in 15 years be like 45, 50, and will be like, I don't want your newfangled direct brain links. Give me my good old fashioned mobile app, right? I don't know what will come up in the next decade, but technology will evolve. So I'm very bullish on fintech, and I'm bearish on traditional FIs and banks, but that's very much as a large sector. I do expect that a lot of fintech startups will fail. Heck, you would expect that. Just look at the startup world. You expect any given year, take a slice of it, whatever, 80% of them should be gone in a decade. That's how this thing works, right? That's the business. But at the same time, even though I'm bearish on the traditional FIs, I expect 80% of them to be here a decade from now. Right? So I'm just like, it's that the world is shifting, but it's shifting at a pace that seems glacial for anybody in the tech startup world, and it seems blazingly fast for anybody in the financial services world. Right? And so it's being dragged over. You cannot stop an idea whose time has come, but an idea as big as this can take a couple of generations.
Shamir, I want to kind of go back to two things. Blend your perspective as an entrepreneur and also your external point of view as an angel into some very successful companies. Tell us about some of those challenges that entrepreneurs face, and also related to why some of these companies have broken out and have become massive, despite all these challenges.
So when I look back on it, right, I think the single biggest thing you need to have as an entrepreneur is just persistence, right? And I have to caveat this by saying that persistence does not guarantee success. There is absolutely no single factor that I know of that guarantees success. Because if there was, then everybody would just figure that out and optimize it, and it would be free money. That doesn't exist. But without persistence, you cannot succeed. But even with persistence, you can fail, right? So if you give up at any point and say, okay, I can't do this anymore, you're right. You fail just by accepting that failure. But by refusing to accept failure, that doesn't mean you will succeed. You can still fail. So it's one of those things where you're 100% of startups will recognize, if you go and talk to founders, that there were multiple moments in the journey where they almost failed. They had no idea how they were going to succeed. And they just scrambled through it somehow. And it's always it's late nights, crazy travel, begging, pleading, cajoling employees, partners, customers, friends, family, investors, whatever it took to solve that problem. They've managed to do it. And they're like, yeah, if I had given up, I remember after the acquisition, I talked to Josh once and he told me that there were at least 3 times in the simple journey where he was ready to give up and throw in the towel and call it a day. And the only reason he didn't was because he didn't want to disappoint me. I mean, we were good buddies before and now, right? And I had to tell him that there were at least 3 times when I was ready to throw in the towel and give up and walk away from it. But I didn't want to disappoint him either. Right? Thankfully, none of those times aligned. And this is the best thing about having co-founders, is that they lift you up when you're down and you lift them up when you're down, right? So much of it is just mental. It is very stressful, right? When Josh and I and Alex, remember there were 3 co-founders. When we co-founded Simple, all of us were married. We are all married today, 15 years later. I'm the only one married to the same woman. So, there is a price that you pay, right? It is an overwhelming, all-encompassing obsession, and friends, family, life, hobbies, kids, all of that can get thrown under the roller of the steamroller of have to get this email done, or this model done, or this pitch done, or this code done, or this X done, right? So so persistence, without it you can't succeed. You can still fail with it. The other thing I would say is timing, and that's like saying, well, how do you hit a 90-mile-per-hour fastball out of the park, if baseball terminology? Yeah, you time the shot. Yeah, but that's easy to say. Teach me how to do it. I'm like, well, just do it 1,000 times. Maybe you'll get it. But there is some skill, there is some training, there is some natural ability, but it's just so much of it is just luck and practice, right? That's why VCs love repeat entrepreneurs, because practice helps. But the timing, and especially I would say timing of focus, right? It is I think I'll give you an example of what I mean by that. So Wise launched in 2011, 2012, around the same time that Simple did. I was an early investor in Wise. I got to see the journey from start to even today, I own some stock, right? Public company. But very early on, they focused on customer growth. And they were solving a very real problem. The international transfers are ridiculously expensive because all the banks hide the cost in the exchange rate, and then they gouge customers a lot, right? And Wise figured this out, and so they gave you a transparent exchange rate and a very transparent pricing mechanism, which was completely unique back then. Now I think the whole industry is beginning to shift that way. So and they actually didn't build out a lot of their own kind of tech behind the scenes. So they partnered with, I think, Currency Cloud and 2, 3 other companies and basically said, hey, we're going to do, I'm making these up, I don't know the exact way, but like, UK to Spain, I think was one of their big early successes. And then now we're going to do UK to the US, and we're going to do UK to X and Y and Z. And we'll just find a partner who can move the money, and we'll build the customer experience and focus on rapidly growing customers. So they grew very rapidly. And within 2, 3 years, I think they had gone from like 0 to like 10, 15 million in revenue. Their profitability was abysmal. They were not even close to being profitable because all their partners were making tons of money from all the volume that they were generating. But they focused on just like taking over the market, getting a ton of publicity and becoming like the media darling because that actually drove customers. Like customers knew about them. That means they got more customers, right? And then there is this giant round of, I think it was 50 or 60 million from Ben Horowitz at A16Z. That was their Series C. And after the Series C, they completely switched. They slowed down growth to the point they were barely growing 2x a year. And they focused on profitability. So they built out their own licensing infrastructure. They built out their own bank partnership. They built out a ton of back-end technology. And I'll say this with almost like an archetype. It isn't actually true, but they went more from being a marketing company to being like a true tech payments company, right? And their profitability dramatically increased. And they were profitable for like 4 or 5 years before they went public. But then their growth rate slowed down dramatically because you can only do so many things, right? You got to focus your energy somewhere. And their Series D was barely, I think, like a 20% up in valuation from the Series C, while the Series C was like a, I don't know, whatever, 6, 8x up from the B. Because their growth rate had slowed down, and VC cares about growth, not so much about profitability. The VC advice, I don't know if it's true, but the VC advice would have been, keep growing as fast as you can. They were like, yep, we've grown as fast as we can for a while. We're going to stop growing as fast as we can, and we're going to switch towards profitability. And they did. And after the D, they did an E and an F and a G. And I believe none of that money ever went into the company. They did not take any external capital after the D. All their future rounds were existing shareholders selling to new shareholders, and the company, like, topping up the cap option pool and rewriting some of the docs, adding a board member here. But none of that money went into the company. It went from, they didn't need it. They were profitable. So they've been profitable since 16 or 17. And they grew. Now they're growing. They're like a 10 billion valuation company growing at 50% a year, right? With over $1 billion in revenue now. So they did it, but they switched their focus, I feel like in a 6-month period, from hyper growth to very, very profitable, steady growth. And that worked for them, right? They had a very successful IPO. Then the market tanked in 22. Their stock went down just like everybody else's. Their stock came back up much better than anybody else's because their profits, just like the market, switched from profitability to focusing on growth to focusing back on profitability. They were like, look, we're going to keep a solid profitability and grow at 50% a year. The market is like, yeah, we like this. You ignore us, right? When we are focused on growth, you deliver profitable growth. When we're focused on profitability, you deliver profitable growth. So I'm like, it's working for them now, even as a public company. But their timing was perfect, right? And if they hadn't raised that giant of a round from A16Z, they might not have been able to fund the switch and focus and the investment they needed to get to profitability. And then if they had focused on profitability earlier, they might not have become as big a company. And if they had focused on hyper growth for too long, they might have just come a cropper in the pandemic or even post-pandemic in 22, because, a lot of folks who grew as fast as possible. I know some other European late-stage startups that you and I could think about that did that, had to go up massively in valuation and then take a massive down in valuation and are still trying to go public. Wise never had that problem. They're like, we don't care about your IPO window. We can go public any day we want to because we have the metrics to go public in the worst possible market at good valuation.
Fascinating stuff. Shamir, thank you for joining. Before I let you go, very, very quickly, what is one area within fintech that you are excited about going forward?
I am going to be contrarian and then say it's actually B2C. Because I did a B2C startup, right? Simple. And that was the heyday of B2C startups, I think, 2010 to 2015, 16. And now it's become very fashionable to do B2B startups. And I am at a B2B startup right now. So I have nothing against that. I'm all for it. Yes, please. But I think what's happened is that folks have gotten I think B2B is almost overinvested and B2C is definitely underinvested. Like even today, in the US, there's 220 million adults, I think, whatever, right? Out of a 330, 350 population. Chime and Current and all the neobanks together, how many customers do they have? More than 10 million, call it 20, maybe 30. It's not much more, right? So all of it, all the neobanks together, still only have maybe 15% penetration. So 85% of Americans don't have a neobank account and probably never had one, right? I'm not saying go out and launch a whole new wave of neobanks, but I think especially with all the B2B investment and kind of infrastructure that's been built, it's opened up the possibility to build a lot more cool B2C applications, especially now with AI becoming a reality. So I'm excited to see where the next wave of B2C takes us, right? Because the consumer problems have not been solved. A lot of Americans still live paycheck to paycheck. Majority of them still bank with a traditional bank, like 80%, as we just said. And most of them still have a shitty banking and financial services experience. So that has to be solved at some point. But I'm even more bullish about B2C outside the US, especially in India. I feel, and in Latin America and in Africa, I think the order is that way. India, then Latin America, and then Africa. But all those places have super exciting things happening. In India, there's now like 750 million Indians on the internet with some of the lowest internet pricing on the planet. And that number was I think 300 million 5 years ago, right? So it's literally in the last decade, 2 entire US populations have been added to the internet in India. And you look at the number of financial services apps they use, there's a lot of payment apps, but there's so much that needs to still happen. I do feel that in the next 20 years, the center of financial and fintech innovation in the world is going to move from the US to India.
Interesting. I'll hold you to that.
Yep. Let's pick a time, 2030. And let's review it and see what the world looks like. We should be about halfway through that transition at that point.
Shamir, thank you. Amazing conversation. I learned a lot. Let's keep talking as always. And then, I'm going to be watching closely all you do.
Thank you, Miguel. It was a pleasure as always.
Thanks for tuning in. I hope you enjoyed this great episode with Shamir, co-founder of Sila. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and means a lot. And if you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off till next week, I'm your host, Miguel Armaza.